Hello viewers, George here, and I have another UFile slash tax tutorial for you. In this case, I've already done most of the data entry, and what I will be discussing is rental property and the disposition of a rental property as well. So I'm going to be introducing some concepts that are intermediate to advanced. So I took care of the data entry to begin with. I filled out the identification section of the taxpayer as follows, and I made her a Quebec resident because it's a bit more complicated, but as you will see, UFile simplifies things because as you do the federal return, in the background it does the Quebec return on its own separately. Identified her as female and common law. Okay, and for a spouse interview, I chose the option complete information, the recommended option. And just to demonstrate the old trick that UFile does automatically, I gave her some eligible dividends. And I only did one entry here because UFile will do two things. One, will do the gross up and the calculation of the credit automatically. And secondly, it will determine if it's beneficial for him to claim the dividend tax credit and the dividends, or to transfer it to the higher income spouse. So that's all the spouse has is dividends. Let's go to Danielle Barnett and also introduce a small amount of income of about uh, yeah, let's say $47,000, and yeah, let's put in an employer. Employment income was 47,000, let's say even. And employment income for Quebec would be 50,000. Now over here, I'm guesstimating, and I might be guesstimating wrong. However, if I am guesstimating wrong, UFile will tell me the proper amounts and the expected results. For QPP and EI and QPIP, the Quebec Parental Insurance Plan, which we have here in Quebec. Okay. We have to pay taxes to the federal government and we have to pay taxes to the Quebec government, slightly higher on Quebec than federal. UI insurable earnings is 47,000. QPP is pensionable earnings is 50,000, and the difference can be accounted for by, let's put this as the QPIP earnings, insurable earnings to 47,000, which is basically the same as EI earnings. Nothing is exempt. There's no special employer code, and the difference between the 50,000 and the 47,000 is the private health insurance plan, which is taxable only in Quebec. Okay. Now, to start up a rental statement, what you need to do is go to the interview setup and make sure you've clicked down below the rental income box right here. If I unclick it, I don't want to unclick it. Let's leave it as clicked because I don't want my rental income to disappear. Not that it will, but there it is. Here it is. Now, address of your rental property income section. This actually refers to the address of the rental unit only, not necessarily your personal address. The only time your personal address should be entered here is if you have a boarder, so they share the same identical address as you do. So here is 4578 Notre Dame, which I believe is different from my taxpayer's current address. As you can see, he lives at 1234 Lucerne. All this information is fictitious. Of course, I answered all the CRA questions and the Quebec questions as well. Okay, let's go back to identification. We covered the first part. Then comes the identification section of the T776, which is the rental property owner's address. And in this case, we do want to have the taxpayer's address. You can designate a name for your rental unit. In this case, I called it the Notre Dame duplex. Here is the year for the rental income. It's the calendar year. Although, as you will see, I have sold this uh, rental property. Now, here I put sole proprietorship, but I can, even if I have a sole proprietorship, I can still share this income statement in any proportion with my spouse, and I'm going to try and show you how. So number of rental units, although it's a duplex, we put 3. All these numbers are particular to business registration numbers and Quebec partnership numbers. If you don't have a partnership in this, a legal partnership, so to speak, with this in respect to this investment, it's really just sole proprietorship, unregistered and whatnot. Okay. After the identification section comes the income and expenses section. So in terms of income, he earned $36,000 of rental income. In fact, because this is the final year of operations, I should tick this box. I didn't. It really doesn't matter. But to avoid any e-file errors, I would recommend that you do it if, in fact, you disposed of your rental income. So where's the rental income? There it is, 36,000. Then she actually incurred some advertising expenses, insurance, interest. Interest is solely mortgage interest, but you have to exclude the capital portion. So you would have to look at your bank statement to get that information. Office expenses, you know, your stationery, paper to make notices, legal notices, and all that. They add up during the year, so you should keep a tab of them. Legal fees and related expenses, if you had to consult a notary to get an eviction notice, uh, write a legal notice to a neighbor that's impeding the enjoyment of your property or the enjoyment of your tenant's property, etc., etc. Accounting and other professional fees, if you pay somebody to do some bookkeeping for you, there it is. And maintenance and repairs related to the units rented only, $3,500. And there you go. Property taxes, that would include school and water taxes as well if they're in a separate bill. Utilities common to the entire rental unit which you pay. Gardening, snow removal, other expenses, do not forget to specify. Um, yeah. Okay, if less than 100% any of the expenses above applies to the business, enter the applicable percentage. So if any of these expenses are related to your personal portion, you would be able to identify them here and put the applicable percentage here. Let's see, if less than 100% of the expenses applies to the business, enter the applicable percentage. So you would identify the expense and put then the percentage that applies to the business over here. Business GST, HST, QST rebate for partners. Again, this solely applies to a property that's held in a legal partnership, and this is very, very rare that it occurs. Most people, and again, this is partnership stuff. This is very particular. In Quebec, if you paid someone to do uh, if you paid somebody to do uh, repairs on your property, uh, either someone or a company, you have to identify them here. This is a compliance enforcement measure. It prevents people from working, it's supposed to prevent people from working in the black market or doing things under the table. and kind of forces the contractor to declare their income. Otherwise, um, if Revenue Quebec has an audit in play, they can find the information from your tax return. Motor vehicle expenses, I don't have any. Partners, uh, there is a difference between this option, spouse co-owner, and other partner co-owner. So spouse co-owner, excuse me, effectively allows you to share this income statement with your spouse without having to redo it, um, right down the middle or any proportion that is applicable. In this case, I want to go right ahead. I'll show that last. Um, go right ahead and claim CCA on my property. Now, a lot of people say um, there is a fallacy out there and says it goes by the tune of do not claim CCA, because if you claim CCA, more likely than not, you'll have recapture when you sell this property. Um, I'll say a couple of things about that. Let's see here. Okay. Notice that you definitely should look up the rental income guide T4036 and T4037. I'm going to do my best to post a link below. Um, Keep in mind that the CRA can change the link from time to time. Um, Keep in mind as well, more importantly, getting back to the topic of CCA, that you may be able to postpone or defer recognition of capital gain and recapture of CCA in computing income if, among other things, the property disposed of is replaced with certain specified time limits. For more information, see replacement property. Okay. Um, so there are some exceptions to the rules. There's also the possibility of postponing the recognition of a capital gain, or if you can designate the property as a principal residence. There are a lot of situations that can arise. To give you a basic example, we'll use though a building um, that was amortized over the course of 5 years. The opening balance of the depreciation was 196,367.16. Business level only. It was purchased in 2010. The cost of the property is important because it's required to calculate recapture. It is a and capital gain, so it is a requirement. Here you go. Did you dispose of this asset class? Yes, in my case. So in the year of disposition, you cannot claim CCA. Proceeds of disposition was 300,000. Now this is the specific amount attributable to the building. It's not the entire amount. And this cost as well is applicable to the building, and the reason why this is done is because you have to separate the cost and the proceeds attributable to the land and to the building into two separate transactions. The reason being is because when you dispose of land, you cannot have recapture or terminal loss. It's not a depreciable asset. You can only have a capital gain or a capital loss. Whereas when you dispose of a building, you cannot have a capital loss. You can either have recapture, terminal loss, or a capital gain, or a combination of a capital gain and recapture. Okay, so how would you enter that in UFile is, well, you also need the legal fees attributable to this part of the property, and then you put calculate capital gain, no to liquidate. But at the same token, if you notice, I don't have a capital gain group here, so I have to go to my interview setup and pick capital gain. which is Schedule 3. Click here, go to Next, and the capital gain keyword group will appear here. Let me show you in more detail the calculation that is behind this data entry. Okay, before I go any further, I can show you the tax return now, and you will see. We'll get a quick glimpse. Okay. All right, a quick glimpse of the federal return. Let's start with page 3. Here's my employment income. I have a taxable amount of dividends that belong to my spouse, but UFile optimized, did an optimization, declared her dividends on my return in order to increase my spousal amount. Here is $56,682 worth of rental income. Notice it's higher than the gross amount. And this is because, in this case, I have recapture. Okay, and I'll explain to you what recapture is in a moment. Alright, so taxable capital gains, though, I have $24,250. Well, this portion is attributable to the building only. See? Building. We need to do this as similar calculation for the land, which takes me to this spreadsheet right here. Okay. I did a 5-year calculation. I should have started with 250,000, which was my ACB. Now, the 250,000 ACB, you could have started with a higher amount of that than the ACB if you had to spend certain capital expenses to get your building ready for use. In this case, we didn't. That's great. And as you notice in year 1, I could have claimed 4% of 225. Well, it's the initial year. But I only claimed 3,050. That could very well be because after taking into consideration all my other expenses, if I were to claim any additional CCA, that would create a loss. And you cannot create a loss with CCA on rental income. You can in business, but not with rental income. So the second year comes by. I claimed, I was able to claim potentially 8,878, and I claimed the full amount. The second year, it's a declining balance method. So this was my opening balance here. Subtract the 3,050, I get 221,950. I claim 8,878. The following year, I subtract the CCA I claimed in the previous year, and now my balance is 213,072, and so on and so on. And then in the end, I ultimately claimed $196,367.16. No, that is not what I claimed. Actually, the actual amount that I claimed is here, $56,632.84 throughout the lifetime that I owned that property. That's monies I deducted from my rental income to bring it to zero over the course of the time that I owned it. I know I don't have the exact total here and that's because I started at a staggered year in the course of ownership. So I'll explain to you how I got these numbers down here. So ultimately, I had bought my property for $500,000. Of that $500,000, $250,000 was attributable to the value of the building, and another $250,000 was attributable to the land. And how do you get this breakdown? There's 2 ways you can get it. You can get it from your property tax assessment, or if you find that the market values are changing more rapidly than what is reflected on your property tax bill or what City Hall tells you, I would recommend that you hire a certified, a chartered uh, real estate agent to give you an assessment on paper, telling you what the value of your property is and the breakdown between the land and the building. Now, if the CRA or Revenue Quebec do not agree with that assessment, they technically have to hire another chartered real estate agent to contest that assessment. So that rarely happens. So you always want to work on a solid footing. So do your homework. Um, I sold my property, my rental property, for $625,000. According to the last property tax bill that I had, the building would have been uh, I would have been able to attribute 300,000 to a building and 325 to the land. So this transaction here, 325 minus 250 minus 1500, I ultimately paid, let's say, $3,000 of expenses in notary fees and and whatnot to make this sale happen. So this transaction, I would have to enter it manually in U-file as follows. Let's put this here and go back to the interview section. I entered, and do not forget that you would have to split this manually if uh, the property was owned jointly with your spouse. You wouldn't have to do this for the building because the rental statement, we do have a mechanism to split it half-half with your spouse, but not for this. Okay, so we'll keep it simple. The rental property is owned only by one spouse for now. Okay, now capital gains. In the capital gains, let's expand this a little bit. We do have a real estate option. Okay, so type of rental property would say land. Description of property, Notre Dame duplex. Province or territory where it's disposed. This is very important if you dispose of a property as a non-resident. Okay, and here I don't remember the exact date. I'll put 01/01/2010 and date of disposition 31st of December 2020. Wait, what 2019? And oh, there, that's good. Okay. Proceeds of disposition 325,000 and ACB 250,000 and another 1,500 of in expenses. And this is not applicable. Your percentage share. Oh, well, look at that. I think we could ultimately share it with a spouse here. Yeah. Let's see. Reserve here. Yeah, play it safe. I would do it manually. All right. So if we look at the return again, a required field was left blank. Okay, let's maximize this and see where is the required field. Designation of property as a principal residence, say no. Okay, click next. And now that's important. Great. Yep, it's important and it's been there now for 2 or 3 years. Alright, so now I should be able to get to my tax return. I highly recommend you review all your diagnostics and messages. I'm doing this jump for being a little bit more expedient. Now on page 3 I should have a higher capital gain, and on schedule 3 you will note Here's my land, and here's my building. Two different transactions. And a nice, handsome amount of capital gains, of which half is taxable. Now, the issue that people have with depreciation, of course, is okay, this person had $47,000 of income, employment income. Uh, if she didn't claim depreciation every other year, um, she would have been in this tax bracket. Now, with the capital gain and recapture, she has jumped two brackets into the second most highest bracket. Um, Granted, however, if you had not taken depreciation, you still would have been a bracket up, I believe. Let's see. Let's calculate that. So that's a 47,000. Um, 47 and the capital gain you would have incurred it. So 47 plus 61, we're around what 100k or so. 108. 108k. So you would not have been in this bracket, but you definitely would have been in this bracket. However, let's take a look at the schedule again. Over the course of this time, okay, you were reducing your income to a level that allowed you to get back or pay less over time. Um, Over time, and that reduction of tax or um, or an increase in refund would have allowed you to probably reinvest that money in bettering your property. Alternatively, you could have also invested those funds, or you could have used it to pay down your mortgage and reduce your interest payments. So definitely, when you are taking CCA over time, provided you don't squander that money and you are investing it over time, that return should offset whatever increased tax liability you have in the end. So that's pretty much what I wanted to point out today. One last point: if this property was shared, um, there is a section in partners, co-property, right? Generate for rental statement for spouse, 50%, and let's see what happens. Next. Okay, and let's take a look at Dennis Marteau now. Okay. Well, now it calculated the building portion. Okay, there you have it. Here is the capital gain schedule. It split everything half and half. You do not have the land portion. Let's go back to interview. Daniel Burnett. And let's explore that option where it's the percentage with respect to the capital gain. Here we go. So land, expenses, and not a gift, not your principal residence. Come on, George. Here. Okay. Let's say it's 50%. What do you do with the remainder? I was being overly cautious when I told you guys to do it manually. Here we go. Yes, I want the remainder to go to my spouse. Let's do next. Clicking next, by the way, is also a default global recalc. Okay, and let's go to Dennis. Let's review. Ooh, it generated an outcome. Yes, they do owe a lot of money, but they were earning a lot of money throughout the year. They were claiming depreciation and getting back a bit more refund and less tax to pay. They were diligent taxpayers and investing that money. Let's see what happens here. Now I believe we have a perfect disposition of a rental unit, perfectly split between one spouse and the other. Hold on. There you have it. So this is for Denny and Danielle. By the way, they are fictional taxpayers. Here you go. Oh, it's I probably make it a lot seem a lot easier than it really is. I guess the major takeaway behind everything is doing your homework. With respect to reading your homework, I would say, yep, reading these two guides. Let me get you to the title page. Rental income. There's a wealth of information in there. The second guide is capital capital gains. There's a wealth of information there. Then do your homework. Okay. This is a pretty easy spreadsheet to set up. I'm going to save it. Okay. Keep in mind in possible outcomes for disposition of land, you can either have capital gain or capital loss. Land is not depreciable property, so for a disposition on building, you need to know the cost, the fair market value, um, and you can have a terminal loss, you can have a recapture and capital gain, and a plain old capital gain in the case where you sold it you sold it with virtually claiming no CCA in the past. Um, I hope you enjoyed this video. Give a like and a subscribe if you did like it. And if you have any questions, don't be shy to ask any questions below. Take care.